Why do stock prices move? One day they're soaring on optimism, the next they're plunging on fear. While valuation models exist, the truth is that prices in the short term are driven by a combination of logic, data, and emotion. In this chapter, we break down the mechanics and psychology behind price movements, helping investors understand what really drives the value of a stock on any given day. At its core, stock pricing operates like any marketplace. Prices are determined by the interaction of buyers, demand, and sellers, supply. If demand higher than supply, prices rise. If supply higher than demand, prices fall. Every trade represents agreement between a buyer and a seller at a specific price, but that price can change rapidly based on new information. Over the long term, a company's fundamentals drive its stock price. Key factors include revenue and profit growth, margins and cash flow, return on equity, and future earnings forecasts. Each quarter, companies release earnings reports, which include financial results and forward guidance. These can cause significant price moves, especially if they beat or miss analysts' expectations. Broader macroeconomic data also plays a key role in stock price behavior. GDP growth, inflation, e.g. CPI, unemployment data, consumer confidence, and central bank decisions, e.g. interest rate hikes or cuts. These indicators affect market sentiment and sector rotation. For example, rising interest rates typically hurt growth stocks like tech, but benefit financials. Markets react quickly to unexpected events. Geopolitical tensions, wars, trade sanctions, corporate news, CEO resignations, lawsuits, product recalls, mergers and acquisitions, and regulatory announcements. Example: a rumor of Amazon acquiring a small company can drive its stock price up 30% in a day, even if the deal isn't confirmed. Emotions play a major role in short-term price movements. Fear and panic can lead to sell-offs, e.g. during crises like COVID-19. Greed and FOMO, fear of missing out, can fuel irrational rallies. Retail investors tend to react emotionally to headlines, while institutional investors may exploit this through algorithmic trades. Even without news, prices can move due to chart patterns, breakouts, support resistance, volume spikes, moving averages and other indicators, stop-loss triggers or margin calls. Large players also move markets with block trades, algorithmic flows, or index rebalancing. Stocks with high liquidity, many buyers-sellers, are less volatile. Thinly traded stocks, often small caps, can see massive swings on relatively low volume. Market makers and high-frequency traders, FFTs, also add complexity to price formation, especially in fast-moving environments. In emerging markets or export-driven companies, global dynamics and currency moves affect valuations. A strengthening dollar, for instance, can reduce profits for multinational firms reporting in USD. Legendary investor Benjamin Graham once said, "In the short run, the market is a voting machine. In the long run, it's a weighing machine." Price is what you pay. Market sentiment. Value is what you get. Business fundamentals. Sometimes the two align. Often they diverge. Stock prices are driven by fundamentals, news, macro data, and human emotion. Prices reflect real-time expectations, not just reality. Short-term volatility often masks long-term trends. A well-informed investor analyzes both quantitative data and market psychology. In Chapter 8, we'll explore stock market indices, what they are, how they're built, and why they're key to understanding markets at a glance. We'll also explain how to trade in practice.